Alright, so we have three financial statements: the income statement, cash flow statement, and balance sheet. Why am I talking about financial statements? Just let me cook, okay? The balance sheet is for assets and liabilities, and the cash flow statement is for the money moving around the business. That looks like enough to run a business with. Then, what's the income statement doing here? Well, it's here on account of the accrual principle. Accountants should record transactions in the periods to which they relate, rather than just when the cash flows from the transactions occur. It is accountant talk for, write down sales when they happen, even if you haven't been given money yet. And it is the backbone of accrual accounting. Told you I'd get there. So, what is this accrual accounting? According to Investopedia, accrual accounting is an accounting method that records revenues and expenses before payments are received or issued. The time between selling a product or service and receiving the cash receipt is called receivables days, which differ between industries. Accrual accounting gave us the income statement to make a trio of financials. And also, to make more accurate recordings of the operational reality of businesses. The income statement records the revenue and expenses to see if a business turned a profit or a loss. The Investopedia definition says the method records revenue and expenses, so put 2 and 2 together. I've made a video explaining the income statement, called PL Account Explained. If you're open-minded enough to dig deeper, the link is in the description. Now, let's see accrual accounting in action, which is always on every day, as it is GAAP. Generally accepted accounting principles, everyone has to do them. Tina is a farmer who just bought a new machine to help her harvest more crops. The machine cost $30,000 and has an expected lifetime of 5 years. Of course, this was a purchase, and so reduced her farm's bank account balance and therefore is recorded as a cash outflow in the cash flow statement. This is where it gets interesting. The accounting community doesn't see leaving the financials with this big purchase affecting it as fair. The machine is an asset for Tina, which can increase the farm's sales. So, the cost is spread out over time. This is depreciation, which I explained in my PL Account Explained video. In the income statement, the cost of the machine will be spread out over its 5 years, which will be $6,000 annually, straight-line depreciation. That PL account video is calling you. I want us to expand our imagined world to get a better understanding of all of this. Tina's farm made $100,000 this year, which it used to buy the machine. All of its expenses leave the farm with a net income of $50,000. $6,000 of the expenses was depreciation. But Tina didn't pay actual money for that expense. So, an add-back is in order. This is adding $6,000 to operating activities in the cash flow statement to fix the offset made by depreciation. This may all seem confusing at first, but eventually you'll get your head around it. This example shows one of the reasons accrual accounting is used. Albeit its complexity, it avoids big purchases massively altering a business's financials, plus it captures non-monetary transactions, giving a more accurate reading of the operational reality of a business. I hope this wasn't too confusing. It took a while for me to get this, but then it randomly clicked. I'm not sure if that will show how your understanding will appear, but it certainly will soon. A like and a sub are always appreciated. See you in the next video.